What's up, everybody? Michael Silva here. You're watching the Daily Stock Market Brief. Do you like my sweet photos of the bear with a wreath around his neck? And Santa riding around on the little bull? This is the show that I do Monday through Friday, 5 days a week. We use technical analysis to get a good sense as to where the market might be headed next. In today's video, we're going to be going over the indices from the daily perspective and a 2-hour perspective, and then multiple indicators. I'm going to be bringing in a couple new indicators just to really check in on the market sentiment. It's an important one to look at. When I analyze the market, I like to look at breadth, I look at sentiment, and I like to look at the price action, of course. Got a lot to talk about. Let's get into it. All right, what's up? Welcome back. We're going to go over the indices now, starting with the S&P 500 on the daily time frame. New record close. Hallelujah. What do you know? What I want to point out here, simply put, is that yes, we are pushing a new record high, but we still have this upper wick on the previous day. All right. What I find very interesting about going on with the S&P 500 as it stands today, we had that gap down and then we ran into the 5 EMA. The 5 EMA has been a very good tool or moving average to watch on the daily, the weekly, the monthly time frames to really see and just see how it acts as support. Now, I forgot to draw in this pattern, but it does look like a rising wedge. But keep in mind, yes, we gapped down today. We pushed lower, and this was kind of to be as expected. We talked about this yesterday in the market brief on the Dow Jones, and I'll go over that here shortly. But notice how it hit the 5 EMA and then the top of this gap, and then continued to press higher throughout the day. So not too bad for the S&P 500 so far. We did break out of this range, this channel right here in December by that big gap up. You can see that back test here today of that support. Once resistance is broken, it then becomes support. We talked about that yesterday. So, well, what did we say? Well, we said that, hey, it's likely to see some sort of a back test take place, maybe even close the gap, and then potentially rip higher. Today, it really didn't go much. It didn't really go anywhere, to be quite honest. It is really sideways, but the big gap down, and then it closed the gap that it left up above. So, you know, we gapped down, didn't close the gap below us, but we closed the gap that we left above us. That's typical. We're still holding this strong support right here from this previous breakout. We're going to have to just continue to monitor this because it seems like there's just a lot of action happening around 3650 level. Okay, let's look at the Dow Jones. Dow Jones, interesting day as well. We're still within this rising wedge type pattern. We had a strong bullish day. So first off, we called this reversal type looking candle out. But what we also mentioned was the possibility of coming back and kind of staying on this upper trend or this lower trend line right here. So what took place? Well, we filled that gap and then we rocked higher. So I'm sorry, no, I was actually supposed to remove that here. So what took place? So we gapped down, we headed a little bit lower into that lower trend line and then pushed higher. That closed the gap that started today. I got to remove that white box. I forgot to do so. On the 2-hour time frame, we've been saying that it's been struggling to get around 30,000. All right, what took place? Well, we had this pretty big gap down. We filled this gap. I left that there too. Man, I got to update my charts. I keep on messing up. Oh no. We filled the gap, right? And then we came and hit that lower trend line. What I wanted to point out is just the ascending triangle is still in action, and it's an overall bullish context. So there's still the possibility to break out and head higher. Now, I saw a tweet by Mark Manvini, I can't pronounce his last name, a professional trader, market wizard, and he was saying the same thing that I've been kind of saying over and over and over again. And you got to be very careful when you're trading these type of breakouts. I'm a breakout trader and I'm also a breakdown trader. So when we start seeing breakouts while we're already in overextended markets, you need to play it with a lot of caution because all this is right here, that's just noise. Now, keep in mind, we're putting in higher lows and higher highs so far. So until that changes, then we might see a downdraft. But right now, we're just seeing a lot of market chop and struggle to get above 30,000. The Bollinger Bands are really, really tightening up here. So we might see some big springs here in the near future. Keep in mind, we're still, strong day overall. Filled the gap that left, that we gapped down. But we still got to break above 30,000 and we have to hold that level if we want to continue to move higher. I'll talk more about some stuff on the conclusion. Let's go over the Russell 2000. Russell 2000, rising wedge, we broke down. What do you know? It's still holding above the 5 EMA. The 5 EMA is that just moving average to keep an eye on. The price action continues to stay above it. Once it gets above it, it continues to ramp higher. Look, we broke out of this pattern, but we can't hold too much weight until we really start seeing it fall down. I think that this area would be very, very likely to come test, and then we might continue to see a ramp higher into the end of the year, potentially maybe even to early 2001. But like I said, in the conclusion section, I'm going to just wrap our head around where we stand in the market. It's just an important kind of thing to understand while we're looking at smaller time frames, and then when we zoom out and look at the bigger time frames. So here is it on the 2-hour time frame, Russell 2000. Bull flag is still in there. We've been pointing that out for the last 3 market briefs. So we had that, right, rising wedge, we broke out, but what did we say? Well, there's a potential of a bull flag right here. Notice how it came down, filled that gap today, and then it bounced from the lower trend line. So it's still acting positive in this little channel here. And then it came up all the way to the top of the trend line and got rejected from it. So clearly there's some consolidation taking place here. Is it going to break out to the upside or to the downside? I'm not too sure. But what I will point out too, that the 50-period moving average is sloping up into this channel, and that could typically act as a level of support as well. Notice how they're trending up. That means it's in bullish context. Very simple way of looking at it. Let's look at the NASDAQ. NASDAQ 100. Double top taking place. Interesting. Very weird day, right? Gap down, pushed lower, tapped the 5 EMA perfectly, found support, ramped up to yesterday's close. It's just very weird. It was literally like a mirage, like a deja vu type of day, right? So we opened here that day, then we closed, then we opened up here, and then we closed there. So we're up 0.01. Wow. So really just a lot of nothing. A lot of chop is what's taking place. What do we need to see happen to see go higher? Well, I mean, we're at the upper range of the Bollinger Bands. We're almost overbought here on the RSI. We are overbought on the stochastic. And we're, the potential of a double top pattern. So, be careful. If the bears capture the 5 EMA and hold it, that could send us down lower into about the 20-period moving average or retest this lower trend line. Okay? When it comes to the NASDAQ has been a very, very strong performer. So this is one that I would say hedge long with if you start seeing it come down and fill gaps. Because once it finds major areas of support, they typically bounce from those levels. So we got to keep a close eye on the NASDAQ 100. On the 2-hour time frame, ascending triangle, I wanted to point out, it had obviously it was pretty overbought. And what I find interesting right here is we came down, we almost back tested this breakout. I would consider this a back test. For the most part, it did come back just around these candle wicks right here and then bounced higher throughout the day, filling that gap that it left in the morning. Now, what I want to pay close attention to here is the RSI. The RSI got pretty frothy right here, and then we saw the pullback, and now we're already pushing to make almost another all-time high with the NASDAQ 100. So if we do get a gap up or if we get a ramp up above 12,500, I believe it's going to do so with an RSI not at this high level, which would cause a negative divergence. And that could be a potentially shorting opportunity or just something to be cautioned with if you do have some longs to take some profits. Now let's talk about some indicators. Like I said, I want to keep today's video a little bit more compressed than usual. We're going to be talking in the indicator section about sentiment. We're going to be going over some breadth stuff too, and just various aspects. Interesting day for the VIX, right? So we have VIX week, it's expiration week. It finished up 1.93%, and so did the S&P 500, right? We already talked about that. It was up 0.18 or whatever. So both days were up. It's just weird price action. That's now 2 days in a row. So falling wedge pattern. This is a bullish type pattern right around this gap area. We got to be careful of a breakout because that can send us a lot higher potentially. And I've been saying around 2750 would make sense for a breakout, kind of a breakout area to kind of maybe find some more resistance at. And that, if it's a very strong move to the upside, can cause a lot of downwards pressure on the S&P 500. All right, now I want to talk about some sentiment surveys. Okie dokie. So this is the AAII, and we've went over this in a previous market brief already. But what I want to kind of just hone in on is that when we reach this really, really high level right here, that's when I kind of brought this chart out saying, hey, sentiment's at a very, very high level, which typically means like when things are way, way, way overextended, you can see that they were over here too as well. and then you see these downdrafts. So it's telling me that, hey, when everything is really, really bullish and all money is being pushed into long positions, that means that there's a lot of potential for a lot of pain to happen in downturns. And if there's pain that happens, that means a lot of selling occurs for a lot of money managers, for hedge funds, for individual retail investors, and it just adds more thrust to the downside. And I'm going to point out, these are just surveys, but I'm going to show you where the money managers currently are positioned here in a moment. Now, what I want to also point out here in 2018, I think I said this on the market brief when I originally brought this up, but when it hit this high, that didn't mean that the market hit this all-time high. It actually hit an all-time high right here, and we continued to go higher as the surveys dropped off a little bit. So this right there was a negative divergence, and we're seeing a very similar thing take place, both here in the AAII and then also in the ratio of the AAII bulls and bears. Okay, so we had a high here and then a low high here, but our price action is moving higher. Okay, something to point out, this is just, it happened before, and what did we see take place? It's happening now. What will we see take place? I don't know, but it's something to point out. Always is very importante. All right, so here we're looking at the S&P 500 on the weekly time frame, but below us, we have the NIAM exposure index, and then below that is the RIDEX asset ratio. Where do I even start? I guess we can kind of just start with the RIDEX asset ratio. It's basically just a really useful tool, and it helps us look at, once again, sentiment. Okay, it's based really on where people are putting money. Okay, this is not a survey as far as an opinion. This is where people are putting their money, and you can see the kind of ratio that's used to calculate it right here. I inverted it to make it look easy, so you can just look at a picture and say, hey, is this really bullish or really bearish? Now, I compared it with the NIAM exposure index, okay? And the NIAM exposure index is really telling us where money managers are positioned, okay? So money managers, you can see, are just full long exposured, like to the max, right? Way up here. It's happened over here. It's happened a couple other times. Happened right here previously. We saw that downdraft. Now, why am I showing this? Well, first off, when you have real money positioned so long, like this is, we're looking back to 2018. It's at basically 0.10. So full on bullish is where money's at. Now, or full long exposure. Now, you got to remember that the RIDEX, it only represents a small fraction, it's like a small amount of assets in the total stock market. So this is just to give us sentiment as to what's going on. And what this tells me right now is people are positioned so long, including money managers, asset managers, super long, and they're super exposed. Now, what takes place if the market turns around? Well, they're positioned brutally for massive pain. And what happens when there's massive pain? Well, they have to sell their assets or their long exposures. So when you have just everyone long, all of a sudden getting scared on a downdraft, well, what do you think happens? Well, these are the stairs up, and the elevator down is very, very aggressive and very, very sharp. Now, this is not to say that this is full truth, and you can even read about these index and the exposure and all that stuff. They say it's not to determine what might take place in the stock market, but what you can see throughout history as when they reach these extreme levels and everyone has their bullish trades on, the downside effect could be quite aggressive. All right, so this is just, it's just insane to see these levels being pressed up against, just so bullish. It's crazy. And like I said, in the conclusion section, I'm going to show you what that actually looks like from a monthly perspective, if it's your first time here. Now, on some other indicators that I haven't brought up recently is because they weren't oversold or overbought. And now I'm like, well, maybe it's still a good idea to bring them up because they have the potential of still going higher, right? So we have the BP NDX, which is the NASDAQ 100 bullish percent index, is based off of point and figure charts. We're at 69, which means 69% of the NASDAQ 100 stocks are on buy signals based on those point and figure charts. All right. Now that puts us at the RSI right around 56.43. So it's floating just in a nice little area. Same with the BP/SPX, 75%. We're not overbought. We're not oversold. We're just kind of just floating around this mid 57 area. All right. So there's still potential room for these to go higher, these two specific indicators. Now, if I look at other indicators, this is the CPC, smoothed over a 10-period moving average. Put to call ratio, also more sentiment. Look at just how steep of a decline this is. So once it crosses below the green line, that's a buy signal, triggered perfectly. And now it's just cruising down all the way to 0.7. When it crosses above the red line, that is the sell signal, quote unquote. But also what I want to point out is where it's coming down to. And it's coming back down to right around the September low of this 10-period moving average. And if you look down right below that, that was actually at a peak point for the S&P 500. And then we really kind of downdraft significantly down into late October. So this could be potentially called the double bottom, and it might reverse back up. And when it does start crossing back over, that is the sell signal. As you can see right here, when it crossed back above, it did still happen to fall lower. And when it crossed above here, fell a little bit lower too as well. So just wanted to point that out, the double bottom. And then we got the breadth of the market. I like to use the NASDAQ oscillator. And we still have that little small negative divergence there. And market continues to push higher and make new records, but it's doing so on pretty weak breadth, which to me is a little bit of a red flag. Now, I've seen this happen before on weaker breadth. Okay, we saw that right here. The market continued to push higher and higher on a negative breadth. But remember what happened very shortly thereafter. So pay attention to these signals. Okay, it's not to predict anything, but it's to prepare us for potential rip to the downside. And then we have the NYSE McClellan Summation Index. This is the fast stochastic max overbought. Sometimes when it reaches max overbought, we get some pretty big pullbacks. Okay, it's happened plenty of times throughout history. All right, so let's go to the conclusion section. I'll show up a couple charts here in just a moment. And if you haven't done so already, I'd really appreciate it if you subscribed, liked this video. I do appreciate it. It gets out to more people, spreads the word. I do these every day. It's pretty crazy, you know, but I do this every day previous to this. I just never put it on YouTube. All right, so let's just wrap up the concluding thoughts. We went over some indices on the short-term charts, okay, daily, which is short-term to some people, and then the 2-hour. I would like to say that the 2-hour time frames and even somewhat of the daily charts are still bullish, right? Bullish patterns for the most part, and just overall in bullish context, right? So keep that in mind. Now, why am I saying that you got to be very careful in these environments and don't become complacent? See, when people get very euphoric, they become complacent. They believe that things can't happen to the downside. But we're very well positioned for a 10% correction at any time, easily. It's a very, very simple. A 10% correction from these levels would really bring us down to, where was it, the October low or September low? I can't remember the date. I'm not good with this stuff. So why am I telling you this? Okay, once again, I bring up the monthly charts. Look where we stand on the upper range of the Bollinger Band, completely disconnected from a 5 EMA, when you can just see through history, it's the most frequently tagged moving average. And we are not only disconnected from that, we are fully disconnected from the upper monthly Bollinger Band. All right, this is the Russell 2000. All right, so when we're seeing this big burst and move to the upside, can it continue? Yes, but what I have to preface and say over and over again is this is how tops happen, right? This is how bubbles burst. They're extremely frustrating for some people. I personally love this. They continue to ramp and ramp and ramp, and everyone becomes bullish, and they start to believe that nothing bad could actually happen. So you need to be very careful if you're a short-term trader. Don't get over-positioned, okay? That's just one monthly chart, but look at this. The NASDAQ, negative divergence. We're pressing the upper portion of the Bollinger Band, completely disconnected from the 5 EMA, and not to mention the semiconductor index, which is a very big portion of the NASDAQ is just clear over the upper Bollinger Band and also disconnected from the 5 EMA. So this itself is setting itself up for a pretty aggressive rip to the downside. Now, traders, if you're a day trader or so forth, you would probably love to play this momentum, but you need to be pretty aggressive because what we're seeing throughout the day is significant amount of chop. So you need to really plan out your supports, your resistance, and your trade plans when you enter. Because if you go into this with no plan intraday, you're going to get burned. Because a lot of the times right now, and that's why I haven't been trading too much, is just because I don't need to be involved with this type of price action. I do like when there's more volatility when I trade, but I don't like holding long-term investments when things get just like this, because I don't want to have a big swing to the downside. So you need to be just very, very careful in these environments. Doesn't mean that you can't make money, but just don't become complacent. Just don't do it. You'll get burned. And if you think that you're better than the professional traders out there, you're not. You know, simply put, you're not. I'm not. Okay. You got to be very, very careful. And the best way to be careful is go in to the trade with a plan, a strategy, and stick to that plan and that strategy. And that strategy should very well include, it has to include position size. Because a lot of people on this move up are feeling like this game is easy. And then they might leverage up more, and they might leverage up more, and then it's all going to come back to bite them. That's all I got for you. See you later.